A pandemic, war, natural disasters and economic strife. The last 4 years have challenged attitudes towards investing, making a tough decision to commit your money to markets even harder. This, combined with the recent surge in UK interest rates, has led many to question the value of investing when cash is earning so much relative to recent history. I'm William Andrew, and I work in the Schroders client group. Today, Alex Funk, CIO of Schroder Investment Solutions, and Tara Jameson, multi-asset fund manager, have joined me to answer the question whether to invest or in cash. So, Tara, why invest when we can get 5% fixed rate at a bank?
I think the answer to this question really comes down to what you're trying to achieve over the long term. 5% interest rate on cash might seem attractive on the surface, but it comes with its own risks. These rates are only available to investors willing to lock their money up for more than a year. By locking up your cash, you lose the opportunity to move into other asset classes that are more likely to beat inflation when the opportunities arise. Ultimately, if history is anything to go by, timing the market is very difficult and rarely works in the long term. There's a real risk when you lock up money that you could miss out on a period when investments rise sharply, which are often sudden and unexpected. If you look at the US data since 1926, cash has only beaten inflation by a mere 0.3%. Equities over the same timeframe have delivered a 7% return above inflation on an annualized basis. The data also shows that holding equity investments for long periods can greatly reduce the chance that you'll lose money. If you're only invested for 1 month, over the past 100 years, on average, you would lose money in real terms around 40% of the time. If you stayed invested for between 5 to 10 years, that percentage goes down to 20%. And even better, the data shows if you held equity investments for a period of 20 years, you would not have lost money when adjusted for inflation during that time. So if you've got long-term objectives for your money, there's a clear case for investing some of it in equities if you're prepared to experience some ups and downs along the way. Please bear in mind, though, that past performance does not guarantee future performance. The value of investments can go up and down, and you may not get back the amount originally invested.
Thanks for this explanation, but my clients are very wary about markets at the moment. Wouldn't moving to cash in the short term be useful?
Yeah, I think as Tara pointed out, one of the most important aspects of investing is spending time in the market rather than trying to time the market. We've done some interesting work at Schroders, looking at some of the largest falls in markets and how long it took to make your money back, essentially. In the 11 previous occasions when the US stock market had fallen by 25% or more, it has taken on average 1.8 years of the stock market to recover. If you had moved to cash in these instances, it would have taken on average more than double the time to recoup your losses. It's easy to say stay invested for the long term, but that doesn't make holding your nerve through this any easier. Ultimately, if history is anything to go by, timing the market is very difficult and rarely works in the long term.
But have things changed in markets? Because many investors are questioning the validity of bonds and equity portfolios after what was a really painful experience in 2022.
Investors in 60/40 portfolios experienced one of their worst years in history last year. And it was particularly painful for more cautious investors who typically have low equity allocations, and they expect their bond allocations to be diversifying and lower the risk of their portfolio. However, periods when equities and bonds lose money at the same time have been rare, and we would expect them to remain so. I explained earlier why we think equity should have a place in investment portfolios, and we still believe that bonds have a place too, as they can perform 2 roles: diversification and income. Over the last decade, against a low and steady inflation backdrop and record low interest rates, bonds provided very little in terms of income, but they were very effective as diversifiers to equity risk. We've now moved to a world of higher uncertainty around inflation. While that created a poor outcome for bondholders in 2022, bonds, like cash, now provide fairly attractive interest rates and can now earn a relatively healthy income for portfolios. The role of bonds as a diversifier will now vary through time, though, as central bank interest rate hiking and cutting cycles have returned.
OK, but what about for new clients? Why invest at a time when uncertainty is so high?
Markets have been more volatile in the 3 years since COVID. But we must remember that markets have always been volatile, and volatility creates opportunity. If you had put $100 into the stock market at the start of January 1990 and held that until 2022, when Russia had invaded Ukraine, it would now be worth $2,141, a return of 9.6% per year. If you had conversely sold out every time the market had shown high levels of volatility and re-entered after normal levels had been re-established, you would have ended up with a mere $878. That's less than half the return of the investment that endured steep falls during COVID, the start of a war, and a financial crisis. Although past performance doesn't guarantee future performance, the data is really interesting to analyse.
Okay, well, given everything that's been said, should I invest more in my portfolio?
It's a very personal question. People need to pay rent, bills, buy food, and feeling financially secure ultimately trumps stock market investing. Be honest with yourself about your willingness to accept potential losses in your investments for the possibility of higher returns. Understanding and maintaining your financial plan set with your financial advisor is crucial.
It's a natural behavioural response to be loss averse. We have natural aversion to losing money. That said, timing entry and exit points of markets perfectly is nearly impossible. It therefore remains important to develop your long-term investment goals, build a diversified portfolio across multiple asset classes, and stick to your investment plan by reducing as much as possible your inherent behavioural biases.
Alex, Tara, thank you for your insights. The reality is that there's no perfect time to put your money to markets. Today's level of inflation is impacting the real value of cash. While there's no crystal ball, evidence strongly indicates that those who have the discipline to stay invested are likely to achieve better long-term outcomes.